Joining us now, Mike Nicolas, portfolio manager for the Oakmark Fund. Mike, it's good to have you here. You guys look company by company, stock by stock, don't necessarily make market calls. What's taking you in the direction of, let's say, a Phillips 66 right now?
Well, Mike, first, thanks for having me. We're continuing to find really attractive opportunities in traditional value stocks, really some out-of-favor businesses. And when there's as much dispersion as there is in the market right now, it really provides a lot of opportunities for us to find mispriced securities. And, we think companies like Phillips and 66 both look really attractive, very statistically cheap businesses, strong competitive positions. And, we expect both businesses to grow per share value at least as fast as the market over time.
A name like Corteva, which, for those who don't know, is the old agricultural chemicals business of Dow DuPont.
Yep.
Is it one of these that is now priced for an economic downturn? Is it just kind of undiscovered? What's causing the discount?
Well, the shares have been quite weak this year. Corteva is a leading provider of seeds and crop protection chemicals to the agricultural industry. And, both end markets require a tremendous amount of innovation. Farmers expect seed yield improvement every year, and nature develops immunity to crop protection chemicals over time. And as a result, the scaled players in this industry have tremendous advantage. And against that backdrop, we think Corteva is really, really well positioned. They've got strong brands and a very loyal customer base, a very promising R&D pipeline. But the shares have been pressured this year. I think it's a combination of channel destocking and weak crop prices. And to us, we view those both as transitory, and it's really afforded us the opportunity to invest in a high-quality, defensible business at a big discount to the market, its own historical trading multiple, and certainly private market values like Monsanto and Syngenta.
Phillips 66, of course, had activist interest. There is a $1 billion investment by Elliott in there advocating for some management and strategic changes. Is that part of the idea in terms of your long holding there?
Ours is a little different. Phillips 66 is the largest mid and downstream energy company in America. And, Phillips was a part of Conoco until 2012 when it spun off, which is another portfolio holding of ours. And, our view on Phillips 66 is that while it's typically perceived as a pure play refiner, the vast majority of its business value resides in its non-refining assets based on our analysis. And that includes things like its big collection of pipelines and storage terminals, its chemical manufacturing facilities, its retail fueling stations. And, our sum of the parts analysis suggests that these non-refining assets alone justify today's enterprise value, that we're getting the refining operations for free. So we think there's a tremendous amount of upside potential here. And on our estimate of normal earnings, the stock is trading at just a single-digit multiple and well below intrinsic value. So for a collection of mission-critical, infrastructure-oriented assets, it would be very challenging and expensive to recreate.
Right.
We think today's value is a bargain.